The JM Financial stable, we have Sameer Bhise, who's Vice President and Lead BFSI Analyst, joining us to talk about their conference, of course, and what have been the key highlights thus far. Sameer, it's great to have you on the show. Thanks very much for taking out the time. It's apt that we speak to you right now because, you have a press briefing lined up with the FM, as also PSU bankers are meeting him on the way forward as far as consolidation goes in the PSU banking space. From the conference, what are the indicators that you have received in terms of how upbeat investors are regarding the financial system in India?
Yeah, hi, thanks. We have almost 40 corporates spread over 2 days and almost 500 to 600 meetings lined up at the conference. And we have particularly focused as a house on a lot of private financials, quality names which have been delivering year after year on growth as well as profitability. So within that space, I think there is a lot of optimism given the broad structural story of market share shift from public sector to PSU, public sector to private banks continues, which is why I would say that on the private sector banks as well as NBFC side, the interest levels remain pretty high.
Okay. Sameer, morning. Tell us, how is it that you're viewing banks right now in an environment of rising interest rates and the cycle itself changing? Which banks do you think stand to benefit most right now, and what is your take on PSU banks? Will they continue to be beleaguered and pressured?
Yeah, so our view structurally has been that the market share shift from PSUs to private will kind of accelerate, especially when you see a sizable portion of the PSU universe currently under PCA. So that story still persists. So while you may have cyclical ups and downs with rates and all, we structurally continue to back the private financials, and despite the seemingly high valuations, especially on retail-led private banks, but we believe that these remain strong compounding stories over next 2 to 3 years, given the penetration as well as market share which they are gaining on the corporate side from PSU banks. On interest rates specifically, if you fundamentally ask me, in a rising interest rate scenario, banks tend to benefit on margins. At the same time, we are currently possibly near the cusp of NPL cycle ending, which itself should help margins recover for some of the corporate lenders. But I think that will be a gradual process. For retail-led private sector banks, we don't see material change in the margin outlook, especially driven by interest rates. For NBFCs, I think there will be a slight increase in cost of funds, which already I think we are factoring in our estimates. Within that, players with strong pricing power and a diversified portfolio should continue to do well, which is where our preference lies.
Right. What's the view with the NBFCs and the continuing growth momentum that they showcase in lieu of the fact that valuations seem expensive? How are investors seeking balance in that, an opportunity perhaps?
Well, in terms of valuations, I would clearly want to highlight that franchises which have delivered strong growth year after year have relatively rich valuations, but they are justified given that there is no change fundamentally on the growth outlook. And as a house, we have been strong backers of some of these large diversified consumer NBFCs. As we stand today, we also like some of the rural financiers, given that there is a bit of a rural reflationary cycle after 2 to 3 years of tough times, say maybe bad monsoons 2 years back, then we had demonetization. So I think these two plays will continue to do well. Without specifically taking names, we think that these companies should do well over the next 12 to 18 months, and we like them.
I'm not quite sure if insurance is under coverage, but if that be the case, what is the view on the sector right now? Because it's clearly been the most sought after, hottest newly listed space or segment in the market. But again, there is no clarity, each company being a standalone case, each different from the other, with a different business model, different kind of segments that they operate in. What is your view at large when it comes to insurance and how that should be approached?
Yeah, so we have coverage on the top 3 to 4 life insurers, and barring one or two where valuations optically appear rich, we continue to like players where there is an increasing penetration of par products, and the distribution franchise remains as strong as ever. So that is how we are viewing. Penetration remains a long-term story. Having said that, near term these franchises currently are heavily relying on ULIPs, but given the whole momentum driven by demonetization and the story of financialization of savings, we believe both life insurance as well as asset management as a sector will continue to do well. We would like to back plays where valuations are reasonable, and that is how we are looking at it.
Okay. Thanks very much for joining us, Sameer, with your perspective on how investors are taking to the entire financial sector in India. We appreciate your insights.
Thank you. Thanks a lot.